Hey guys, so one of the biggest drags on performance on investing is taxes, the other one being fees. But thought we would do a little bit more of a beginner video, just looking at sort of ways to reduce tax on investing. So this may sort of be common knowledge to a lot of people, but you may get something out of it, and sort of hopefully the newer investors will take some useful information from it. So a lot of people's sort of main investment is going to be their pension, sort of company pension maybe. If you get a company matched pension, it's going to be hard to beat in terms of returns. If they're sort of putting in 100% of what you're putting in plus the tax relief, you're essentially getting sort of over £2 for every pound that you invest. So yeah, that's going to be sort of quite difficult to achieve in sort of say an ISA on your own. But I do always think with people looking at sort of potential early retirement and that sort of being the reason that they're investing, maybe the pension isn't the best idea. It's worth doing some sort of compound interest calculators maybe, and sort of how much you're saving and think that you can save in the future, and sort of trying to work out a rough sort of retirement potential, early retirement age, because most company pensions, if you're sort of fairly young now, you're going to be looking at sort of 58 years old before you can get at it. So some people will sort of concoct some complicated strategies of sort of investing in the pension, and then alongside that having an ISA, say, to sort of bridge the gap. So you could retire at 48, for example, live off sort of the ISA and other income until 58, and then the pension would kick in. But I always think some people seem to underestimate how much money you can make sort of compounded over time. You could end up at sort of 40, 45 maybe, sort of able to retire in sort of total net worth, but it's all locked away in the pension. And so you have to work essentially when really it isn't needed. But certainly, as I say, pension sort of allowances, if you think you're going to be sort of 58 or near that, then it's difficult to beat, really. So you can invest at the moment £40,000 a year into pension schemes, and yes, as I say, it'll depend on company matches and what you can do with it within there. If you're sort of allowed to pick your own investments and that sort of thing. If you're younger, you might sort of consider going a little bit more aggressive. But yeah, I would think sort of pensions, you're kind of going to know if a pension is going to be for you, really, sort of depending on your age and investment sort of timescale. So generally, we would move on to the ISA. So the ISAs, or individual savings accounts, are going to be the sort of main accounts that sort of longer term investors are going to want to use if they're not using a pension. So you have £20,000 a year that you can invest. This has been sort of the same limit for quite a while now. It used to be less sort of about 4 or 5 years ago, and it sort of stayed at £20,000 for a little while now. No sort of indication of them increasing that. And so you have 4 different types of ISA. You have cash, which is not sort of very attractive at the moment with inflation. These are just sort of a standard savings account where you'll get sort of 1% interest, maybe less, and sort of lost a bit of relevance recently because they've introduced a interest tax sort of allowance, so you can earn £1,000 in interest without paying tax on ordinary savings. So if you're at sort of 1%, you're going to need £100,000 in cash to earn £1,000. So I don't think we really want to be having £100,000 in cash if we're long-term investors. So yeah, cash ISAs have been sort of largely made irrelevant. Stocks and shares ISAs are going to be the main investment vehicle for most long-term investors not wanting to use the pension. Innovative finance ISAs are probably best for most people to stay away from. These are sort of risky investments in very small companies generally, and you get a lot of sort of tax relief for taking that risk. But I wouldn't sort of base investment decisions generally on solely on the tax. If you wouldn't invest in them outside of these, then it's maybe not the best idea sort of to be going for this just to try and save tax. You could end up losing potentially a lot more than you save. But yeah, more advice may be needed if you're looking at getting into that sort of thing. And you have lifetime ISA, which are quite useful if you're looking to buy your first home, or sort of coming up to retirement. So it can be used for sort of retirement purposes or purchase of a first home, and you can put 4,000 of the £20,000 annual limit in a lifetime ISA, and you can have stocks and shares ISAs as well, one of each per year. So yeah, the lifetime ISA is quite good. The government top up 25% of what you deposit up to the £4,000 limit. So yeah, if you're looking to, as I say, buy your first home or sort of for retirement purposes, then it can be a little bit better than a stocks and shares ISA. Although the sort of providers, there aren't really a lot of decent providers for the lifetime ISAs just yet. Probably means you're going to end up with Hargreaves Lansdown, which previous subscribers will know my thoughts on. So yeah, the ISA, stocks and shares ISA, is very good. Yeah, you can have sort of ETFs, individual stocks, and all sorts in there. And there's no dividend tax and no capital gains tax at all. So it's worth sort of really putting as much as you can into these per year. So the £20,000 limit resets every April, generally the 6th of April. You'll get a new £20,000 allowance for the year. You can sort of use that with the same ISA that you currently have, or you can open a new ISA. You can transfer your current one to a new one and then invest the £20,000 in the new one. So generally, people who are sort of investing under £20,000 a year are not going to have to pay a great deal of tax at all, if any. So the only tax you will have to pay within an ISA is withholding tax on foreign dividends. So any company within the UK, you wouldn't pay that on, but foreign dividends, sort of most people end up gravitating towards US companies, and sort of any dividends that you get from there, even within the ISA, will have sort of, it's 30% technically from the US, but sort of most brokers will have a form, a W8 Ben form that you'll fill in when opening the account, and this sort of reduces it to 15%. So yeah, you'll still pay 15% on the dividends received from sort of US companies. Some European countries are more. Germany, for example, sort of ends up at about 26%. Japan, some people invest in Japan. I think they are 15 from looking at this. Sort of handy table just to maybe bookmark or sort of keep a note of from PricewaterhouseCoopers. This sort of gives you basically all the countries in the world that you could be investing in and their dividend withholding tax rates. So yeah, you're going to pay that even within an ISA. There's no getting away from that. So if you are lucky to invest more than £20,000 a year, or you sort of come into a lump sum, for example, and want to invest that, then you're probably going to be in a general investment account, and you need to start looking at capital gains tax and dividend tax most likely. So you get a annual allowance of capital gains tax, which is quite nice. Even outside of the ISA, you're not necessarily going to be paying tax straight away. So you're allowed to earn £12,300 currently in as of 2022 on profits that you make from selling shares. And this Tax Scouts is not someone that I've used before, but they provide some quite handy tax calculators for dividends and capital gains. So you can put in the current year, which some sort of calculators won't do. They'll be basing it on the previous year. Rates sort of haven't changed this year, but they have changed for dividend tax. And yeah, so they're asking what you're making money on. Property is a higher rate than shares and crypto and that sort of thing. So part of the reason I'm not all that keen on sort of physical property. And yeah, so if you say earn £40,000, for example, and you make £10,000 in capital gain outside the ISA, then there's going to be zero to pay because that falls within your 12,300 allowance. If you say make £20,000, then part of that will be in the £12,300 allowance, and that would be zero. And then you would pay 10% capital gains tax on the remainder because they sort of calculate the difference between the higher tax band and your salary. So the gain that you make sort of bridges the gap between the amount you earn sort of elsewhere in your main job, for example, and the higher rate tax band. So that's quite good if you sort of do a lot of investments but don't necessarily make a lot. You can actually get in at this sort of 10% cheap rate, and potentially when going sort of semi-retired or into full retirement, obviously you're not going to have a great deal of sort of salary or main income. So quite a good deal of your capital gains could end up being sort of obviously within the allowance every year, 12,300, but then potentially only taxed at 10% rather than the 20%. So if you were to make, say, £30,000 while earning £40,000 a year, then you start to obviously use part of the capital gains tax allowance, and then part of the gain would be taxed at 10% up to the higher rate tax band, and then sort of the remainder of the gain gets taxed at the full 20% rate. So you can actually earn quite a lot in capital gains per year, sort of using the ISA and using your sort of annual allowance, and then even after that only getting taxed sort of 10%. So in the UK we have that quite good. So yeah, that's capital gains tax. You can sort of have a play around with this calculator a little bit more. So the other tax obviously is dividends. So dividends in the ISA aren't going to be sort of taxed other than the withholding tax, as I say, but outside of the ISA, in a general investment account, say, or in a limited company. I don't really get into sort of limited company stuff, but similar to capital gains, you have a dividend tax allowance. So this used to be £5,000, but has dropped down to 2,000, which is quite annoying, but yeah, is what it is. So again, sort of saying a person earning £40,000 and making £8,000 a year, say, in dividend income, 2,000 of that is going to go free in the allowance, and then the remaining £6,000 gets taxed at 8.75% now. This used to be 7.5%, but this has gone up to 8.75% now. So yeah, not too bad. Obviously, the sort of allowance is quite a bit lower than capital gains tax, but yeah, earning £2,000 in sort of dividends, if you say an average sort of 4% yield, you're looking at sort of £50,000 in investable stocks to sort of give you £2,000 dividend. So that's not too bad. Obviously, higher yields or lower yields are going to affect sort of how much you would have invested to be using up that allowance. But yeah, it's not too bad. And then, so if you say earned £20,000, then yeah, you are going to be pushing up into sort of some fairly harsh rates. So if you earn £20,000, say on a £40,000 income, you wouldn't pay any on the first 2,000, and then the similar to capital gains tax, the amount that would take you up to your higher rate tax band is still paid at 8.75%, but then anything in the sort of higher tax band is 33.75% now. So it's even higher than property, which yeah isn't the best necessarily, but obviously earning sort of £20,000 in dividend income, you're going to be looking at sort of £500,000, say, in dividend stocks at a 4% yield. So yeah, that's sort of obviously a fair amount, and that's all outside the ISA. So it's not too bad, but generally I would sort of be thinking capital gains is the thing to have in the ISA, to be honest. If you think your stocks are sort of growth stocks, they have the potential to go up a great deal, then I would sort of think have those in the ISA and have dividend stocks and sort of more steady stocks outside the ISA, if that's your situation. Obviously, you fill up the ISA as much as you can, but if you are sort of overspilling into a general investment account, then personally, I take the approach that sort of the more dividend and steady stocks would go into the sort of general investment account, and your stocks with the sort of more potential to go up and appreciate, I would sort of have in the ISA. So another great way of saving tax is real estate investment trusts. So another great way of saving tax while also investing in property is real estate investment trusts. So these are companies that trade as a stock but own real estate and sort of generally rent it out and provide the income to shareholders. So they will generally they have to pay out 90% at least of their income to shareholders. So they're not sort of reinvesting generally into their own company. They sort of generally would borrow debt or sort of issue new shares to acquire more properties, and sort of maybe the small amount that they retain, but generally, yeah, they're paying it out to shareholders. And these sort of aren't all that popular with non sort of UK investors, because the income that you receive is sort of gets taxed as income tax for the most part. Some REITs will sort of have income tax payments and sort of dividend payments. So you have to sort of divide these up and sort of report them yourselves if they're in a general investment account. So they're not all that popular, but you can put them in an ISA and sort of not have to worry about any of that. So because they distribute 90% of their income to shareholders, they don't actually generally pay corporation tax. So essentially, if you own one and keep it in an ISA, it's income from a company that isn't paying corporation tax, that you then don't pay income or dividend tax on in an ISA. So it's sort of a double win, really, or essentially cheating, as I like to think of it. So yeah, quite like REITs, but it's just a word of caution that really they are sort of best to hold in an ISA, essentially, to sort of get the benefit of them. So for the UK investors, they are sort of a lot more popular. Sort of foreign investors don't have the benefit of the ISA to put them in, so they generally don't have as much sort of appeal, basically. You've got your sort of big companies like Realty Income in the US that you can have. You will still pay dividend withholding tax if you hold those foreign companies, but you can have UK ones. I've got things like Tritax, Big Box, and there's other companies like Segro that do sort of industrial real estate and sort of other residential types and specialist types and that sort of thing. So you can have a look around for yourself at various real estate investment trusts, and yeah, they can be quite a nice tax saving opportunity. So, final sort of way of saving tax, I guess, if you're looking for a bit of diversification, would be investing in precious metals. So, they can provide a sort of long term hedge against sort of downturns and money printing and inflation potentially. And there are sort of ways to invest in this without paying tax, even outside of an ISA. So all coins sort of issued from the Royal Mint, if you're in the UK, would be exclusive of VAT and capital gains tax. On the gold side, so any capital gains don't even count towards your capital gains tax allowance, or if you've used up the allowance, then you won't pay any on those. Gold is VAT free, but silver and platinum, if you're looking to invest in that, maybe you would have to pay VAT on. So that sort of dampens their appeal a little, but you could be potentially sort of hoping for a larger capital gain on those. But yeah, gold, for example, you can buy a sort of Royal Mint Britannia and not pay sort of capital gains tax down the road. Obviously, you don't have to buy a 1 ounce, for example. If you haven't got £1,500, you can buy in sort of smaller denominations, 1/10 of an ounce if you like. You can also buy sovereigns, which are slightly different and not really my favourite because they're not 100% gold. It's 22 carat gold and sort of 7.3 grams of gold per 7.98 gram coins. So yeah, not really, not my favourite. There's sort of copper in there, and just seems they're very sort of liquid, very sellable. There's sort of high demand for them. But if you're going to buy gold, I would just rather buy whole gold, if you like. So yeah, that can be a nice sort of diversification out of stocks and bonds and that sort of thing, and ETFs, without sort of having to worry about tax if you don't like sort of venturing out of the ISA and sort of worrying about tax. So yeah, essentially, if as I say, if you're earning sort of under £20,000, you can pretty much put all of it in an ISA. And yeah, if you're earning sort of over 20,000 or you're investing a lump sum between sort of the capital gains tax allowances and sort of dividend taxes and maybe investing in a bit of precious metals, you can sort of get round paying essentially any tax, and maybe sort of some overspill could go into the pension if you think you're going to be sort of getting towards that age for retirement. So yeah, I thought this was just handy sort of overview to potentially saving some tax in the UK. So leave your thoughts in comments below and like and subscribe. See you soon.